Okay, tonight this is Ng Chi Seng. Tonight I'll be sharing with you the topic on SPACs, Special Purpose Acquisition Companies. So we start with a disclaimer. The information and materials provided in this talk is for education purpose only. Nothing presented in this talk should be construed to be a recommendation to buy or sell any specific security. The information, software, and techniques presented should only be used by investors who are aware of the risks inherent in trading. Singapore Microcomputer Society, SMS in short, and its executive committee have no liability for any investment decision based on the use of software, any trading strategies, or any information provided in connection with this talk. So the synopsis for the next talk is, what is the purpose of this SPAC? What are the challenges facing this listing, the future of listing, SGX SPACs guideline, education of investors and future company directors of SPAC, and then we have a summary, then a Q&A. Okay, this is a pictorial presentation of how does a SPAC work. So first, the investors, you can buy in the SPAC share at an IPO at on average about $10 per share. So when you buy into this company, the SPAC company, they will collect the money in the IPO and then put into a trust. And the trust money, they will, while they are going to secure the so-called company to list, will be invested in some sort of bonds or treasuries. So for the investor, that's item 3. For every $10 you invest in the company, you will get, or that SPAC company, you will get 1 share and proportionally either quarter to 1 warrant. This warrant is meant for you to subscribe for more additional shares if you like, once they have merged with a SPAC company. So each $10 investment, each investor receives 1 share valued at $10 and 1 quarter to 1 warrant to purchase a share at 11.5. And this is going to be higher than your initial investment. So once the SPAC goes public, it tries to find a target company to acquire and bring to the public. And next, if the SPACs find a target company to acquire, then each investor can vote to get their $10 back plus interest or get the shares in the new company. That means if you invest in the $10, when they found a new company to invest in, you still have a choice at a meeting to decide whether you want to take back your money or you want to invest in the share of the new company that they have acquired. So if a SPAC does not find a target company to acquire, the investor will get their money back plus interest. That is the traditional model, that is how this SPAC works. So in case of Singapore, later we'll see the structure. So you will see that you will have a look at the typical life cycle of a SPAC. The blue side, the color, show you that the time frame that you will so-called go through. So on average, you take 3 to 6 months, and then for the initial investment, when they promote the IPO phase, and then there's pre-IPO, that means preparation work for the IPO. And you require up to 24 months before they merge or acquire a so-called target company. So once they got the IPO going with the money already and they put into the treasury bond, so they will look for the target company, and then they will negotiate with the target company to merge. And if they reach an agreement, then good, they will ask the investor for an investor meeting to approve that investment. And if it's approved, you move onward to here, then you close the SPAC. Then the SPAC, they will de-SPAC they call it the SPAC. That means the SPAC, the shell company will be taken out, and then the name of the actual IPO company will be listed on the exchange that it has applied for. So that is they wind up the SPAC and return it back. And if it's not successful, that means they did not approve the target sale all. So return to target sales again, or they will dissolve, wind up the SPAC and return investment to shareholder. So you can see the whole time frame, 3 to 6 months for the initial pre-IPO, up to 24 months to complete the acquisition, search and negotiate, and then up to 5 months of executing the merger. So you imagine how long, 19 months plus 24 months, right? 2 years. So it's quite a, no doubt they say this is a faster process compared to the typical IPO listing. But of course, the typical IPO listing, a lot of background work also involved that you may not know. So here we have a quick look at the comparison between a SPAC merger and a traditional IPO. IPO means initial public offer. So you have a good company or you have a IT high-tech company that you want to go for listing. Traditionally, you will engage a merchant banker to help you to prepare the documentation for the IPO and get your accounts in order so that you can present the statement of accounts and how good your company are, and then you will go for IPO. So the process of traditional IPO is very comprehensive preparation involving whole organization, and you also have to deal with analysts and market participants, and then you have to also fulfill the security exchange review process. That means, like this is SEC review is referring to US market, but in Singapore market, you will send your documentation to MAS, and MAS will look at your initial so-called IPO prospectus to review through and all this before they will allow you to go for the actual IPO launch, right? So this is the process. And the pricing. You will price your company share at the time of the IPO, and then you will also disclose the market risk of the same. So the cost, so full range of direct expenses and direct costs. Typical IPO fees is anything between this is more just a guideline. So normally, if it's a very huge company or huge fundraising activity, then the fee can be much in terms of percentage will be much lower. But if you have those small company that you are going to raise fund, and then amount of fund that you are raising is, let's say, below 10 million Singapore dollar, then the percentage fee that you likely to incur will be, because a lot of fixed expenses incur, legal fee, those merchant bank fee, those marketing promotion company fee, and all that, and printing of IPO brochure. So that part sometimes can add up to even 10% of the funds of the amount of money you're raising. So sometimes actually, whether is it wise or not to so-called go for the IPO route, is actually depending what is the objective of the company. Because if you go through so much so-called trouble to prepare your company for IPO, and then if you are not going to raise so-called a substantial amount to help you to so-called expand your business or to make your company more popular or able to do more business, then what for you go to the market to raise funds? Because typical Chinese businessmen or small businesses, they will not like to go IPO, because IPO, you have to disclose a lot of things, and then every quarterly or every 6 months, you have to make reports to the exchange so that the shareholders can know what is happening in your company. So a lot of work involved, and then a lot of constraint also. When you are operating as your own company, the money is on the right pocket, you put it in the left pocket, is acceptable. But the moment you are a listed company, you cannot suka transfer money from one account to another and treat the business account as your own personal account, and then suka go and draw $5,000 out and do whatever thing you want to do, all this thing. You cannot do that. You have to go to the normal business rule of doing the transaction, withdrawal and deposit, and justify the amount and get the shareholders approval or get the board of directors to as the approval, all this thing. So as for the SPAC merger, so the timing preparation says about 3 to 4 months. Here it is 6 to 9 months. So limited interruption to management, owner, and employee. When you prepare for SPAC merger, the paperwork is less troublesome. No doubt there is due diligence required, but executed by a small dedicated team. So the exchange that you're listing, example, US exchange, the review process can be deferred until after the closing. Okay? So the preparation work or the review process is sometimes can be delayed. So in that sense, you don't need to meet a lot of deadlines. Pricing. Certainty on price early in the process, because you say all typically SPAC company you price at $10. Limited risk from fluctuating market conditions. Sometimes IPO are being delayed or postponed because the market condition is very volatile. So you don't want to run the risk of once you list your share, the whole market tank, then your share trade below the IPO price. So that's why there are this pricing risk. So cost. So in terms of SPAC merge type of IPO, your lower direct expenses and direct costs. So typical underwriting fees about 5%. So whereas IPO is typical of 6%. But the work involved in IPO is much more than this factor normally. So dedicated, experienced, and proven others you need a very dedicated or proven senior management team. And then you have to have supplementary supplement management. So for SPAC, the management team has to get approval because you are the one like the custodian of the money initially collected. So what are the characteristics of SPAC? The capital structure. So retail investors as well as institutional investors are usually the sources of fund, as mentioned earlier. And 100% of the money raised in the IPO is held in the trust account. So investors get to own units. 1 unit, every $10 you own 1 unit plus option. And in return for the capital, with each unit comprising a share of the common stock and a warrant to purchase more stock at a later stage. The units became separable after IPO into shares of the common stock and warrant, which can be traded in the public. So the founders of SPAC, by paying a nominal consideration for the number of shares that resulted in a 1/5, sometimes it may be a very ownership stake in the outstanding share after the completion of IPO. So the founders of the SPAC will get compensated or pay to this method of, they will pay a nominal consideration for a number of shares that result in a 1/5, sometimes may a bit, very a bit ownership in the outstanding share after the completion IPO. Those founder shares mainly compensate the management as they are not allowed to receive any salary commission from the company until an acquisition transaction is completed. So that means initially the SPAC company management team do not get paid or salary or commission. They only will be given so-called ownership in some outstanding share once the acquisition is completed. Okay, continue. Characteristics of SPAC. The management and experienced management team usually leads the SPAC composed of 3 or more members with prior experience in private equity or merger and acquisition exercises. So the management team does not get any salary, pioneer fees, or other cash compensation before the business combination, nor it participates in a liquidating process if it fails to consummate a successful business combination. There are minimum conflicts of interest within the SPAC structure because all management team agree to offer qualified prospective target business to the SPAC before any acquisition fund, subject to pre-existing fiduciary duties. Fiduciary duties, that means the financial duties. Governance and regulation. The SPAC company must make full disclosure to shareholders of the target businesses will and SEC, in Singapore case is SGX or MAS merger proxy statement that includes complete audited financials and terms of proposed business combination that allows them to decide whether they wish to approve the business combination. So all common shareholders of SPAC are granted voting rights at a shareholder meeting to approve or reject the proposed business combination. The trust assets are only released, that means those money held in trust only released if the voting shareholder approve a business combination or a business combination is not consummated within the amount of time allowed by a company's articles of incorporation. So that gives an overview of how the SPAC structure lies, and then how important is the management team in the SPAC. So early this September, Singapore Exchange launched the new rules allowing special purpose acquisition company, in short SPACS, SPACS, to list on its main board, a move that will make it the first major browse in Asia to offer such listing. You know, Singapore, everything also want to be so-called champion, first in this, first in that. So this one, they also want to claim that there will be a first in Asia to offer this listing. Of course, our Hong Kong stock exchange also are looking closely onto this issue and working out the mechanics whether to encourage or not to encourage the formation of SPAC company. So simply stated, SPACs are blank check or shell companies. That means when you invest in a SPAC company before they acquire a proper business, the company itself is not doing any business. They have a shell structure only, formed by a group of investors called sponsors that raise cash through an initial public offer and then acquire an existing company. So they'll get the money from those interested parties, and then after they got the money, then they look for a existing business that is going to be listed, and then if they find that the business structure suit their intention or is good enough for going for SPAC listing, then they will negotiate with them and tell them so-called buy over the business and then go for listing, right? They have been around for decades. So SPAC is not born only this year or last year, no? But more than 10 years ago, this concept of a SPAC company is already in practice in the US and part of other countries. But for the last 1-2 years, it has become more and more popular. And then especially in 2020, fundraising activities using the SPAC so-called approach, they have raised a record of $82.1 billion US dollar, according to Investopedia, this investment company. So the good points or the good prospect, or why people are so-called, or why the Stock Exchange of Singapore, SGX, is so keen to do that. First, they say they claim that retail investors now have the opportunities via the SGX to diversify their investment portfolio and invest in private companies that would otherwise have been available only in private equity space. Okay, just for information, there are a lot of other methods of fundraising by startup companies, also example. So they have for startup company, before they go for IPO, they normally have different phase. They have called the Alpha, Bravo, Fund, Charlie. So they have different phase of raising fund for those, especially those high-tech companies that are planning to go for public listing. So before they become public listed, they are already raising fund to the private equity so-called space or the area. So firms now also have an alternative route to raise capital, one that could allow faster access to public capital and liquidity compared with a traditional IPO. Of course, because the process to prepare the paperwork, the IPO documents, and to get so-called the screening by the stock exchange, whether they qualify to be listed in the main board or second board or whatever board. So those initial preparation work and screening often is quite time consuming. So for operating companies, maybe sometimes it's quite tedious to go to so much process. So sometimes you may heard of reverse IPO or the backdoor listing. So sometimes some companies who want to get listed in the Singapore exchange, or for that matter in any exchange, they will, instead of going for the new listing, that means the initial public offer, they look at existing company that has been listed in the exchange and look at them. Some of them are operating almost like a shell company. That means they are no longer actually doing any business, but they are still as a listed status in the exchange. So for whatever reason, sometimes the company is no longer doing those type of business they were meant to do, or their business they have sold out to other people. So their balance is a shell only. That means they are not actively doing any active business. So sometimes people will consider to buy over such a shell company and then list the company, release the company, or so that it meet the exchange requirement to be called a listed company. So that is another so-called faster route to go for public offer. So well-known Singapore companies already involved in the SPAC deals include ride-hailing and food delivery giant Grab Holding, and then online real estate firm Property Guru. So you can see that why SGX is so kancheong or so proactive to so-called set up this guideline to allow well-known companies to list to the SPAC space in Singapore instead of the SPAC space in US or any other market. Because if you don't have the so-called these guidelines or the structure that allow SPACs-based kind of approach company to raise fund to this area, then all the SPAC fundraising will by default will go to USA, right? So allowing SPACs on the exchange, the Singapore exchange, could also help SGX attract more listing, although SPACs have already gained prominence in other global financial hubs. Now, quite often, we use this as an example. Grab itself. Grab already conducting a lot of businesses and all these things. So they are also working out the sums to check when is the right time to go for IPO. But now with this SPACs structure, it is more helpful for them to work with certain SPAC company so as to acquire by this SPAC company to get listed. That will be a much simpler and more cleaner process. So that's why Grab went to the SPAC route and get listed in overseas. So same as online real estate Property Guru. Property Guru is an Australian incorporated company, but their main so-called website and those online transaction work are mainly in Singapore and then Southeast Asia and all this side. So right now they're also going for IPO, and then they will going the SPAC route, already in working with this SPAC deal. So what are the reasons? The main reason they claim that is the process is much faster than a traditional IPO and can generate strong valuations. Whether you list in a traditional IPO or you go to the SPAC space, most of the company want to get a good so-called valuation for their business. So that means they can get better value for the shares when you go for listing. So once the funds are raised, the SPAC sponsor has a fixed period to de-SPAC, which is to identify a target company and complete a merger or acquisition. So the SPAC sponsor will look for company. In this case, they look for Property Guru, and then they say, okay, Property Guru, we value you at so much money, and then we would like to take over your business and help you to go for IPO. So they will discuss and work out certain arrangement. Then if they agree, then they proceed. So if a suitable deal is not found, then investor can redeem the capital. So SGX has announced set of rules under the SPAC framework, including a minimum capitalization of $150 million. So you can see that the Singapore guideline for SPAC listing is quite lenient. That means the capital size need not to be very huge. You can come to the Singapore market for listing. Of course, those who so-called wish to go the SPAC framework, they would like to have a much so-called higher capitalization. As I mentioned earlier, it's not worth to go for IPO. You are not raising big money because the fees and all the trouble involved is quite huge. Next, the SPAC must occur within 24 months of the IPO. That means after you the SPAC company found the target company and then they go for listing. So the process is called the SPAC. And all this must happen within 24 months of the IPO with an extension of up to 12 months subject to condition. So these are the listing guidelines to list as a SPAC company in Singapore Exchange. So the MAS, the Monetary Authority of Singapore, noted that the framework positioned SGX as a regional first mover in serving the financial needs of Asia fast-growing companies, right? So basically, SGX hope to be the first mover. I mean, they want to be the early bird like that, so can attract the big businesses to list in Singapore to SPAC so-called structure. So with this so-called structure, SGX will have to ensure that it does substantial due diligence on SPAC sponsor when they apply for listing. And the first few SPAC approved will be crucial because the success and failure of the SPAC all depends on the SPAC sponsor or the management team. So if the quality of the management team are so-called not so strong, and then they may not able to acquire the target company so easily, and then also they may not have all the connection and the experience to help the target company to go for the proper IPO. Then you will have a lot of delays. So the reputation of the management team of the sponsor is most crucial in this type of structure. Of course, in future, investors like you and me, or the small investor, or even the corporate investor, they should also do their research on SPAC sponsor before sinking in their money. Because unlike you invest in the IPO, you already got a lot of detailed information about the businesses the company is involved and how long they've been doing this kind of business, and where are the competition, where the money coming from. I mean, how they actually make the money by selling the goods or selling the services or designing something. So as such, under this SPAC sponsor, you and I, the small investor, we also have to do our research on the SPAC sponsor before we invest in the SPAC company. In a normal IPO, investors will have control over whether to invest in a particular company. Because when you IPO, you already know, this ABC company, they are a real estate company or what, the business structure, more or less, you already know quite well. But in the SPAC investment, you will not have any existing business operation or even stated targets for acquisition at the time of its IPO. Investors thus have no idea what the company they ultimately will be investing in. So you are just investing or trusting the money into somebody, hoping that within the 2 years or 3 years, they can find a target company to invest and then be SPAC. So the sponsor also running on a 24 to 36 month clock to de-SPAC and find a target company before they have to return the investors' money. And investors should pay close attention if a target company is only selected when nearing the deadline. So as an investor, if you no doubt 24 months or 36 months seem to be quite long, but quite often they're not. The so-called the SPAC management team may not have the ability to close the deal within this period, and sometimes they can even ask for extension for another 6 months or so. So if you, as investors of the SPAC, you find that the management team are not so-called good enough, I mean, as after invested, and you have to be careful that whether you should get out of it, or you want to still continue to invest in it. So how does Singapore Exchange put in place the type of safeguard? So according to our SGX Regulation Chief Executive Tan Boon Gin, he said the requirements for SPAC listing increase sponsors' skin in the game and their alignment with shareholder interest. This is quite a big phase. So they want to so-called tie the management team of the SPAC company that their interest should be aligned with the shareholder interest. I mean, you cannot let down the small investors. One such rule is that sponsor must subscribe to at least 2.5 to 3.5% of the IPO share, units or warrant, depending on market capitalization of the SPAC. That means in order to make sure that the sponsor management team also express their trust in such a structure, they must subscribe. That means they also have to subscribe 2 to 2.5% to 3.5% of the IPO share unit, depending on the size of the market of the SPAC. That means beside the retail investors and corporate investors buy into the SPAC company, the management team who organize such a SPAC company are also required to commit up to 3.5% of the IPO share. Right? There will also be a moratorium on sponsor shares from the IPO to the de-SPAC stage, as well as a 6-month moratorium after de-SPAC. There will be a further 6-month moratorium thereafter on 50% of the shareholding for applicable resulting issuers. This moratorium is something like a retention period. So they put in a number of retention period for the sponsor share from IPO to SPAC, as well as, so this so-called make it, or they tie down the management team so that they don't do things improperly. They make sure that they put the mouth where the money is. That means they also have to show their commitment, and then also the retention period, because quite often even in normal IPO, the top management team or the management team of the company that listed company, or those major shareholders, or those people who hold more than 5% share of the listed company, quite often they are not allowed to dump the share during the IPO stage. They have to hold it for at least 6 months to 1 year, and they hold different percentage at different period that they are allowed to sell into the open market. Effectively means that they don't want them to take advantage of the later investors. That means they being the early investors, so they normally pay less price for the share. So if they once for IPO and they start to get out of the market, then effectively the company will be less supported by the so-called major shareholders. So that's why even for SPAC, they also similar to IPO. IPO company also subject the same thing. Major shareholders of IPO companies are not under the SPAC stage, also subject to moratorium of 6 months, 1 year, or 2 years before they can sell and all this. So they have a so-called like a commitment period. Education. Singapore Exchange SGX has said it will work with Security Investor Association SIA to increase retail investors' understanding of SPAC through efforts such as education programs, right? So similarly, the exchange will separately partner the Singapore Institute of Directors to educate further future directors of SPAC on the responsibility and duties expected of them. So this SPACS is more to educate the retail investor. And then Institute of Directors are more to educate directors of companies who will be likely sitting on the board of directors of SPACs acquired company, to tell them what are the do's and don'ts and the requirements they have to fulfill. And in addition to the normal education process, SIAS plan to support SPAC play an active role. We plan to support SPAC by commissioning independent reports upon the introduction of the SPAC space deal to give retail investors better informed voting decision. So once the target company has been so-called found, and then the SPAC company has de-SPAC the deal, and then it become a proper listed organization, then this SIAS hope to commission independent report on each de-SPAC deal, so to give the retail investor better informed voting decision. Like here again, this hope to better educate and make the retail investors to be better, more informed. Because quite often they're not. If the company don't go for IPO or go to this, whether to the traditional IPO channel or to the SPAC channel, they have no obligation or to give you a detailed write-up about actually what the business is like, what the competition, how long they have been in business, and who are the major shareholders, and what are the roles of each and those executive team doing, and all those things. So only when company go for IPO, they have to really sit down and write out all these things so as to keep the investing public informed actually what is this company they're investing in doing. All right. So SIAS planned also to ask research firm to form a panel which SIAS will administer. Among other things, the research firm will help to evaluate the information on the proposed de-SPAC transaction, including the attractiveness of the target business, discuss the pros and cons of the transaction, including implication to investor, make peer group price and valuation comparison, and do scenario analysis for share redemption and warrant and convertible exercise. These are all typical research companies will do, right? Whether you are listed to SPAC or listed to the traditional IPO. This is a summary of why this SPAC structure is getting more and more popular. So for the benefit for company, there is more certainty. So unlike traditional IPO companies can negotiate the terms of their public listing offering, giving employee and shareholders more certainty, right? So why people go for SPAC? Because they feel that there's more certainty, right? Speed. SPAC merger process take 3 to 4 months, much shorter than the 24 to 26 months in a traditional IPO, right? Speed to go for listing. Next thing, strategic partnership. These are benefit from the company point of view. Some SPACs offer experienced leadership teams that a company could use for guidance and after going for public. So even after going for public, SPACs can expect the leadership to continue. So that is a benefit from the company point of view. So benefit for investors, why SPAC? So retail investor involvement. Retail investment can't access traditional IPO. This structure allows them to get a piece of the pie with some restriction. Quite often than not, the private equity area you want to invest in for retail investor is quite difficult because the let's say for these high tech companies and all these things, they are doing their fundraising round. They normally approach very good or solid so-called investors who know what they are they are going in for to come in and invest. And if they can sell their concept or idea to this company, it will be easier for them to go for round 2 and round 3 of their fundraising exercise. So that is why during this type of fundraising exercise for the retail investor, often or not, so-called this so-called private equity space, they will not have a chance to know or to have a chance to participate in, because those fundraising exercises, the amount sometimes is substantial, and also the risk is much higher, and then the rewards are still not very clear. So if you ask a general small investor to get involved, it's quite a risky undertaking for them, because any of the unlisted so-called these are private equity funds, for every 1 or 2 success, there may be more than 10 or 20 of failure. So the success rate is not so high, right? So it's very risky from the retail investment. Redemption option. If the sponsor cannot find a target company in 2 years' time, and investors are unhappy with the chosen acquisition, initial shareholder can redeem their share for their money back. Okay, what is the benefit for investor? This is one of the most important benefit. That means, in case within this 24 months, while they're looking for a target company to the SPAC, and they are enabled to do so, so with retail investors, you have the choice to redeem the share for the money back. That means there should be a clause whereby you are allowed to so-called withdraw your cash without penalty. There's a so-called second good benefit for the investor. And additional profit opportunity. Institutional investors can invest in the initial SPAC and purchase additional shares after the acquisition through warrant. Remember the initial early on I mentioned something like your $10 you can buy one share plus additional warrant, and this warrant entitle you to subscribe for more shares when the SPAC company is going to be listed or they have found their target company. The last point is benefits for sponsor. Using the SPAC model, the SPAC IPO process is relatively simple as the shell company faces fewer regulatory hurdles than traditional IPO. This makes this route potentially easier than, say, raising a new VC fund. VC fund is a venture capital fund. Venture capital fund, all those investors are known as a very professional investor. They know what they are going in for. So if the company want to market before pre-IPO, they want to market or sell to the VC fund, they have to really have a good story to sell. Because VC fund, every day they are looking or talking to all the potential target companies that they can invest, right? And then, of course, often this comes back to the question, who needs who more? When you are a venture fund, of course, they want to get into the investment exercise as early as possible, because the earlier phase of fundraising exercise for any venture capital fund, normally the risk is much higher and the reward is also much higher. And then if you have spotted this is the type of business that you think is the future business direction, then they will definitely want to invest in, right? Significant upside, so benefit for sponsor. Of course, they are the early birds, so of course the upside potential is going to be very significant. And then finally, if you invest in late stage company, a SPAC merger allows sponsor to invest in a later stage private companies and potentially help to drive strategy post IPO. So another advantage for SPAC is that just before the company go for so-called the SPAC company so-called found the target company, and before the target company so-called combine into the SPAC and then become the new entity, this is called late stage company. So if you are in the late stage company, the SPAC merger allows sponsor to invest at later stage private company and potentially help to drive strategy post IPO. So some companies, they're already preparing for IPO. I mean the process for a while. So they are called the later stage company. That means they are almost ready for IPO. So if a SPAC company found out in that search, this type of late stage company, then it will be like a blessing in disguise, because you no need to do so much groundwork already. The groundwork already done by themselves. So it's quite attractive from the investor point of view if all these things are already in place. Like so, okay, it's very good benefit for sponsor if you also they target and found late stage company who are already on the path to go for IPO. Okay, that's about all that is I have for you today. So Any questions?